Let's
Less
go.
tax for landlords. What a name that is. Hi, everybody. Nick Watchorn here from LMPG. We're back on Wednesday night for our 16th, isn't it, Anthony?
It is number 16, indeed.
Number 16. And like I always do, this is being recorded, and under the new GPDR rules, I'll get that right one day. If you don't want to be recorded, can you please leave? Got that out of the way now. And I'm not heading tonight. Paul Hilliard, the operations director for LMPG, will be running tonight, as he has a lot more about accountancy and tax than I will probably ever learn. So I'm just to really introduce everybody. And before I do, I just want to introduce my newest member of staff, Melanie Ambler. I'd like to say everybody to every. Did I get that name right?
Ambler.
Ambler. Yeah. Will you say hi to everybody?
Hi, everyone.
And
Hi,
members.
Welcome.
Yeah. Be nice to her. She's only been with me since Monday. So if you get her on the phone, be very gentle. I would like her to stay. But yeah, thanks very much for coming on tonight, Emily, and saying hi to everybody. Really, Paul, I'm just going to hand it all over to you, and you can introduce everybody who's talking.
Okie doke. Thank you.
All right.
Thanks, Nick.
Brilliant.
Good evening. Are you sure you finished?
I'm off. I'm just going to mute.
Blimey. Good evening, and is everyone looking forward to tonight's lockdown events? Please enter a big yes in the chat, just so I know you can all hear me. I'm really keen to always say about this subject. Maybe it's because I'm the operations director, or because my accountant's being within me, as it's always something that strangely interests me. Now, Nick's told me to make sure this is snappy and funny, but you all know about my reputation for jokes. I'm sure it's a big relief for everyone, though, knowing that we can finish on time tonight. Has he gone? Yes. As Nick isn't hosting the event. But I just say that timing is all down. It's all down to you, our audience. We will talk as long as it takes. So tonight, not only is this one not really a product, but it's a service that is something I believe that you must get sorted immediately. We don't have one expert on tonight. We have two as our guests to talk about something which Benjamin Franklin said, in this world, nothing is certain except death and taxes. Now, that's given me something to think about because LMPG is all about usually property and property-related matters. So a clue is that this one doesn't necessarily, is related to property, but it's certainly not death. But as I said, it's given me an idea to see if we can arrange a deal on funerals and cremations. Let me know after the event if you think this is a sensible idea. I might need it myself because Nick will be after me if I mess this one up. Yes, tonight is all about taxes and not just the ones you jump into. Moving swiftly on, let me introduce you to our guest speakers and founders of Less Tax for Landlords. That's Malcolm Rose and Chris Bailey, both of whom I met over 2 years ago when I was completely lost in what I should be doing to protect my portfolio. But instead of just protecting it, they have helped me to show me ways to expand it tax efficiently. So let me introduce you to Malcolm Rose. Over to you, Malcolm.
Thank you, Paul. Okay, and good evening, everybody. So I'm going to just get a presentation up. I understand that you like to interrupt as your talkers or presenters go through, so that's fine. Feel free to chip in, but we'll take you through just a little bit of a story. So we'll just get this rolled up. Hopefully everybody can see that. So I'll just jump straight into this because Less Tax for Landlords has been around for about 5 years now. And we came together as basically 3 different companies. That's my company, which is a business planning and mentoring organization. Chris, who's on the call tonight, who's a chartered accountant with a chartered accountancy company. And our fellow founder was Tony, a chap called Tony, who some of you I know would have come across before, who ran an estate planning company. There was an opportunity to put those 3 professional disciplines together and come up with a sum that was greater than the parts, if you like. That's what we've done. So we've been trading Less Tax for 5 years, but all we're going to do tonight is just to give you a bit of an overview as to why you might use a protective business structure and indeed what might be best for you. Now, the health warning here is that I cannot and Chris cannot give you the answer to your personal situation this evening. So we're going to give you an overview of things. There is a particular kind of structure that tends to work for portfolio landlords who satisfy certain criteria, and we'll explain that as we go along. But if you're running a business, you have got the ability to be taxed in a different way to if you're not running a business. So we'll start from that position, and I'll now jump straight into the problem. So as I say, if you want to interrupt anybody, feel free, but otherwise we'll just flow through. So,
Just a caveat on that, Malcolm.
sure.
That is to say, if you want to interrupt, type a comment in the chat, a question in the chat, and if it's relevant to the section that Malcolm's talking about, then either myself or Paul will ask the question. Don't jump on yourselves, because we've got about 100 of you on here at the minute, so we can't have everyone coming on at once.
Okay, thanks, Anthony. All right, so moving on then, I'm going to go straight into a problem here in terms of what we're doing. So basically, we're all familiar, I hope, with the Section 24 legislation and the desire to pay no more tax than one needs to pay, let's put it that way. So George Osborne introduced the Section 24 legislation a number of years ago now. This is where the mortgage interest payments for where you own properties in your own name would no longer be allowed to be claimed as an expense in the calculation of your normal taxable income, which is a crazy thing if you think about it. It's just really a bit of a tax on turnover rather than on what we would expect to be paying tax on, which is the profit of the business. So there's been lots of toing and froing about it, lots of claims and counterclaims, but the legislation is there, and it is there certainly for the foreseeable future. So I just want to quickly show you the impact of that. Now, the chart you've got in front of you demonstrates the blue line is talking about the payments on account. Now, the payments on account is something that you would normally pay in January and July of each year. And in January and July, in the January payment, you're paying not only half of the expected tax bill, but also a balancing payment for where you may have paid, where you should have paid more tax than your payments on account sort of created in the previous year. Now, this is best displayed by the graph you've got in front of you there. So the blue pillar, if you like, represents the payments on account. The orange bit represents what you might pay over and above the payment on account. Why is that going up? It's because we've introduced this Section 24 legislation that basically means your tax bill goes up for 4 years. In the 17-18 tax year, 25% of the mortgage interest was disallowed. In the 18-19 tax year, 50%. Last tax year, 75%. And from the 6th of April this year, it's all gone. Now, so that's why you get to the orange bits, and we call this the tax escalator effect. But you'll notice there that 2022 is the biggest pillar. Now, why is that? The reason why 2022 is the biggest pillar is because the last tax bill that we would have had, so January of this year, related to the period where we were only losing 50% of the mortgage interest. So the 75% that was gone last year, you won't see that until your accountant gives you your accounts for basically the last tax year. You'll be getting that at any point now, between now and next January. And this tax year we're in at the moment, whilst 100% of it has gone, clearly we're not going to account for those. You're not going to have to submit those accounts until the following year. So you won't actually see the real pain of that potentially until January 2022. So this is why we say 2022 is the worst year for landlord cash flow. However, most of you will be aware that the government did allow the payments on account for July of this year to be deferred. Some of you will have taken advantage of that. Some of you may have decided not to. The net effect is what I've got in yellow there, if you didn't pay that second payment on account, that's going to make 2021 a very heavy payment on account year. So you've got a lot of tax to pay in 2021 if you've taken advantage of the deferral. That can be actually part rectified by setting up a business structure that will reduce your tax liability from here on moving forward. So if you can set up a protective business structure that's going to reduce the size of that big blue pillar in 21 and 22, then the actual cash you're going to end up paying in 2021 will be reduced. So that's all I wanted to identify or sort of show you in this particular part of the presentation. And you'll see there, if you do get a structure in place, then the total tax represented there by the height of those pillars can come down substantially. Now, I'm happy to take questions on that later on, but in essence, I'm just illustrating the actual issue that we've had there and what can be done if you put a protective structure in place. But what type of structures can you have? So let's go back to the basics. These are the types of options, if you like, that buy-to-let landlords can consider. You can own properties in your own name. You could actually set up a limited liability partnership. You could put your properties into a limited company. You could do a hybrid mixed partnership. Now, we'll talk more about that later on. Or, of course, you could overcome the issue by setting up and getting out of the market. Now, for most landlords, and I don't know whether this applies to you or not, it's very much a personal thing, but for most landlords, if they're running a profitable business, then getting out of the market and giving up that profit is probably not the best thing to do. It's better to find a way around the issues that have been put in place by the government's changes. So that's what we do. We help people get around those issues and challenges. So quickly, why would we use personal names? The way that the Section 24 legislation works is that if you are actually a basic rate taxpayer, so in other words, if your taxable income is £50,000 or less, then this legislation does not affect you. So if your total income, bearing in mind you're no longer allowed to calculate your mortgage interest as an expense in calculating that total income, if your total income is less than 50,000, then you're not impacted by this. So there's no need to sort of change anything unless you're looking to grow and the tax changes have actually stopped you in your tracks from doing what you want to do as a business. So again, everything we talk about tonight, everything we talk about in this company is about running a business. If you and your married partner, between you earn less than 100,000 on the same basis, as in with your mortgage expenses not counting in that calculation, you actually don't really need a structure. You can keep it in personal names and you can just reallocate the income between you in a different way. So someone might have 30,000 from a job, for example. You might be making a 70,000 profit. You could allocate that 70,000 in a different way to 50-50. By doing that, you can both be earning, say, 50,000 rather than one of you 65 and one of you 35. It just makes it more tax efficient. As I said, if you've got no immediate plans to grow, then the personal names may still be the right thing. But a lot of our clients, a lot of people we talk to, they've actually been stopped in their tracks from growing their business because of tax. And we feel that is particularly shocking. We don't feel that's right. If it's right for you to grow the business, then it's right for you to grow the business, not to allow the tax changes to stop you. So if that's your personal circumstance, then we'd be very keen to talk to you. Why might a limited company be the obvious choice? If you haven't got any beneficiaries, now the reason I say that is because if you own properties in a limited company, then unless it's a trading business, in other words, you're set up to buy and sell properties, flip properties, if you're looking to retain the properties and you know it's just a genuine buy-to-let kind of setup or serviced accommodation kind of setup, you keep the asset. You've got to be careful because your business could be deemed to be a to be an investment business. If you're an investment business, then HMRC will come along when you die and basically have an opportunity to take a 40% chunk out of that business because of inheritance tax. So if you've got beneficiaries you want to pass your business onto, then owning things in an investment limited company is probably not the right way to go. And again, Chris will cover that more of that later, and I'm sure you'll ask questions on it later. Obviously, if you're not planning on taking the money out of the limited company, then it might be okay. You have to understand, if you don't understand the way it works, if you're in a limited company, you'll be taxed on the profit of the limited company. You'll also be taxed on any money you draw out as well. If you are thinking about incorporating, in other words, moving your portfolio from your own name into a limited company, that does not, under normal circumstances, create a director's loan. The equity just gets rolled into the value of the shares. So it doesn't create a director's loan. So any money you take out, you'll be paying dividend tax as well. So again, all solutions are geared to what you as an individual are trying to do. Sometimes it makes commercial sense to have a limited company. You might be in a joint venture. There may be quite a high level of risk involved in a development that you might be doing. There may be reasons why it makes sense to stay in or to buy in a limited company. But sometimes additional flexibility is needed. So if we're looking to overcome Section 24, we're looking to maintain the existing lifestyles, in other words, have the same kind of net outputs, if you like, from your business, irrespective of the tax, and you want to continue to develop your business, then we've got to look at something different. So an alternative solution is probably going to be better for you. So for the rest of this webinar, we're going to look at one solution in particular. Now, this is the limited liability partnership and a limited company. HMRC will refer to this as a mixed partnership. Sometimes we talk about it as a hybrid business model, but that's all it is. It's a mixed partnership. It's a combination of human members and a corporate member. So for example, a limited company that are all members of a limited liability partnership. If you're single, you can set up a partnership with a limited company. So if you're single, this does not preclude you from going down the partnership route, because you can be one partner and a limited company can be the second partner. So if you are a portfolio landlord or aspire to be, and you're looking to grow a sizable professional property business and you just want to crack on with this, then the LLP may be the right way to go. However, there is a kicker in this, and that is, and we'll cover the technical reasons for this later, but that is because HMRC will only allow the benefits of a mixed partnership if you are running a legitimate business. It is not there for people who are simply looking to avoid tax. So the key to this is, are you running a business? And again, I'm sure we'll take questions on that later on. Right, so that's it from me for now. I'll be back later on, but I'm going to hand you over to Chris now.
Before you move on,
Sure.
Malcolm, we just got a quick question in saying, what do you mean when you say that in a limited company you'll be taxed on money you draw out? Is this something to do with directors' loans?
Yes, so if you've bought a property in a company and you've actually bought it in a company at the outset, then the deposit you've put down on that property, if you like, would constitute an influx of money into the business. So that would be a director's loan, and you could draw down against that director's loan. But if you own the property in your own name at the moment and you're looking to incorporate into a limited company, that would not create a director's loan. Therefore, you'd have no director's loan to draw down from. So if you were to take money out, you would be taxed on it by one mechanism or another. So I suggested it might be a dividend tax, but it might be a salary. If you paid yourself a salary, then you're going to pay income tax, you're going to pay national insurance. So whichever way you do it, you're going to be taxed as well.
Brilliant. Thanks. Yeah, that's great.
Okay.
Thanks, Malcolm.
All right, so I'm going to stop sharing and Chris can pick up. Over to you, Chris.
Thanks, Malcolm. So I am the technological idiot in Less Tax for Landlords. So I shall try and share my screen now, and it will probably go wrong because it did last time I did it. So we'll see what happens. If it works, it works. So here we go, guys. Let's see where we're at here. So I want to be that one there, and I want to share that with you all, and then I want to go into that one, don't I?
You smashed it.
Brilliant, Chris.
Are we off and running?
Yeah, you just need to go into slideshow, then we're there.
Yep, I thought I'd done that then. There we go.
That's it.
Yes,
Want
brilliant.
to see that? Brilliant. Thank you. So, what is the hybrid business model? Well, let's start from the very beginning. And as Malcolm's alluded to, there are various ways that you can actually hold a property. So you can hold it as a sole trader or a partnership. You can hold it in a limited company, obviously, limited liability partnership, or you can hold it in what we call the hybrid business model, which is basically a combination of a limited liability partnership and a limited company. That is known as a mixed partnership, as Malcolm has said before, because it's got a human member as well as a corporate member in it. So a lot of you will hold your properties in either your own names or you and your wife's name. So in other words, a sole trader or a partnership. So that means that the mortgages are in your own name. It means all the profits or the losses are in your own name. It also means the capital gains are in your name because you own them. So when you sell a property, you physically have that capital gain. It also means that because the mortgages are in your name and the interest is in your name, then the finance costs, in other words, the interest is restricted to a basic rate, 20%. That's the tax credit that HMRC give you against the mortgage interest. It also means if you own them in your own name, that the taxes that you pay on the profit is taxed at your rate, at your marginal rate. And this can be 45% above £150,000. Very, very, very important point. Number 7 on the slide. You are taxed on the profit, not what is drawn out to live on. What you draw out to live on is called drawings, and under UK partnership tax rules, they are not taxable. You are only taxed in a sole trader or a partnership on the profit that is allocated to you in that partnership or sole trader business. And it can be inside your estate for inheritance tax, the property, because it's in your own name and you physically own it. So a limited company, though, let's look at the limited company. So the limited company, the properties are owned by the company. The mortgages are owned by the company. Sometimes you get a higher rate of interest in a company because most companies have set up newly to buy properties, which means they don't have a credit history, which also means that the banks deem them to be a higher risk than a personal loan. So what do the banks do? Well, the banks either want you to have a personal guarantee or they want to take a debenture over the company or a mixture of both. Now, what's a debenture? Well, a debenture is a charge over the company's assets, which means that if the company can't pay its mortgages, the bank can come and take the property back. Also, if you give a personal guarantee in a limited company, then you wipe away the veil of incorporation. Now, what that means is very simple. The bank or the person who you've given the personal guarantee to can actually come in and demand that money from yourself personally. You have guaranteed that money personally. And it doesn't have to be a mortgage. It can be on a lease of a van. It could be on a photocopier. It could be on a franking machine. There are lots of things that people give personal guarantees for that they don't really realize that they have done. So be really careful with that piece. Any rents obviously are received in the company's name, excuse me, because the company owns the properties. Expenses obviously paid by the company because they actually own the property, as I just said. And if the company sells something, it makes a capital gain. If it's got mortgages on its properties, then obviously the finance costs are allowable because they're not individual finance costs, so therefore they're allowable. And the tax is the responsibility of the company, and that's 19%. That's the corporation tax rate as we sit today in the UK. The company is taxed on the profit, pays 19%, and as Malcolm just described, you are taxed to what you draw out as earnings or as dividends, as pay as you earn, for example. National insurance is payable on some earnings. You might have tax on overdrawn directors' loan accounts. There's pension payments that need to be paid under auto enrollment. There's lots of other taxes that are hidden behind a company. And then it's, as Malcolm said earlier, if the company owns the property, it will be deemed to be an investment company, and therefore it'll be inside your estate for inheritance tax.
In the previous slide, you mentioned drawings.
Yes.
Now, are they the same as dividends?
No, not at all. Drawings from a partnership are not taxed. They are not. They are not a taxable element. They are essentially you drawing out previous year's profits that you haven't drawn already. So when you have a partnership and you make a profit of, let's say, £50,000, you don't get a check for £50,000 at the end of the year. What physically happens is your accountant says, you've made a profit of 50,000, the tax is 7,500 or whatever the tax may be. That's it. Over the year, you may well have drawn money out against that future profit. If you've drawn 40,000 out, you may have another 10 to draw out. You may leave that 10 in and draw it next year or draw it the year after. But you will have paid tax on that 50 on the actual amount of money, the profit that the partnership made profits of.
Thank you.
And then what's a liability partnership? Pretty much the same as everything else that I'm talking about. So the properties are owned in the LLP's name, the mortgages are in the LLP's name, profits or losses are in the LLP's name, capital gains are in the LLP's name. The finance costs are disallowed because a limited liability partnership is taxed under partnership rules, not corporate tax rules. The LLP's taxes are the LLP's responsibility, but they are taxed at your rate. They are taxed on the individual's rate, marginal rate. So again, could be 45%. Again, as I said previously, limited liability partnership is actually taxed under UK partnership rules, which means you are taxed on your profit, not what you draw out to live on. Again, really important. And it can be outside of your estate under certain circumstances for inheritance tax purposes. So our hybrid business model, what's all this about? So it takes advantage of the sole trader and partnership. So it takes the good things out of that. So you don't get taxed on what you draw out, you get taxed on the profit. It also takes advantage of the limited company. How does it do that? Well, some of the profits can be taxed at 19%, not 45%, for example. So what we do is we join these two structures together in a partnership, and that partnership is a limited liability partnership. It's still a partnership, so it's still taxed under partnership rules. The maximum tax rate, 20%, because you have a personal tax rate at 20% and the company's at 19% tax rate. So if you allocate the profits to the individuals, 20% tax rate, allocate profits to the limited company, 19% tax rate. Finance costs can be treated as an allowable expense. Why? Because the individual partners will be lower rate taxpayers. So what does that mean? That means they get a tax credit of 20%. If you pay tax at 20% and you have a tax credit of 20%, that means one balances the other out. So there is no effect of the finance cost rules. Capital gains can be allocated to the company, so that can be 19% tax, corporate tax rate, and it can be outside of your estate for inheritance tax under certain circumstances.
Before you move on, Chris, I've got a couple of queries. Someone's asking, do you mean one company per lender? This was on the previous slide.
It can mean that. It absolutely can mean that. Because if you think about it, if you have two properties in the same company and they go with different mortgages, they can't both have a first charge on that company's assets. So it could absolutely mean different companies for different properties and different mortgage companies. And I've seen that happen in practice. It can absolutely mean that.
Okay. Then, as regards limited company, if they put children as directors, what's the IHT position on that when obviously someone dies?
I think they're probably the questioner probably means children as shareholders as opposed to directors, because directors have got no ownership in the company unless they're a shareholder. So yes, if you have children in as shareholders, then they will have a share of that company, clearly. But you've got to be careful when you do that. If you have an existing company and you give shares to your children, that means that you are selling some of that value in that company to your children. So you've got to be careful. There are tax consequences of doing that. And again, as Malcolm said at the very, very start, we can only give generic advice here. We can't give absolute perfect, individual advice, but we can do it afterwards, obviously, in private discussions, clearly.
Yeah. And lastly, while we're on that, What happens if you're already on a high rate tax as an employee, say?
Then the partnership, and I'm coming on to that bit now, actually, so don't steal my thunder, but we can talk it through with it now. So this will be what the partnership, the LLP could look like. I say could look like because it could take numerous forms, but we could have a partnership at the top, 2 members, individuals, and a limited company as a partner or a member, and then shareholders in the company being the same as the shareholders in the LLP, the individuals in the LLP. Now, good question there, Paul. What happens if I'm already a 40% taxpayer? Well, the partnership is run by a partnership agreement. And in that agreement, it says the members will decide on the profit shares every year. What does that mean? That means that if I'm a 40% taxpayer, I might not want any profit share in the year, because what's going to happen? I'm just going to pay 40% tax on it. So why would I? I might not want a profit share. If I might say, no, I don't want a profit share this year, thanks very much. It can all go to the company. That's in the actual agreement that the partners sign when the LLP is set up. And we also have a shareholders agreement that's in the limited company, which runs the limited company, exactly the same as a partnership agreement would do. Now, when you were talking about where do we put children, or can we bring children in, because most companies that we set up are brand new companies, there is no value in them. Therefore, we can bring children in at the very start, and their value in that company can grow from day one. So that's what the basic structure would look like. So what's the tax position? Well, the tax position on an LLP are similar to limited companies. So as I've said, 20% for an individual, 19% for the corporate partner. There's no tax on withdrawal of capital. Why is that? Because it's coming out of the LLP. And what have I said? 0.7 on all those 3 notes, previous 3 slides rather. 0.7, there is no tax on drawings, withdrawal of capital, that sort of thing, because you've already paid the tax on that amount of money in previous years. And what does all this mean? Well, what it means is that the business has more cash to spend. It's not spending money on tax. Therefore, what does that mean? That means then that it can go for better deals. It can have more cash. It can give a bigger deposit. It can get less interest payments on its mortgages. What does that mean? That means that it can make more profit. We at Less Tax want our clients to pay more tax for being more successful. That's what we want. We don't want everyone to pay no tax, clearly, because that would just be silly. What we want is people to run proper businesses and pay more tax because they're more successful. And we show you how to do that through our structures.
Just on the structures, Chris, before you get into a detailed example, a couple of questions, and I think the answer is going to be variable. Raj is asking what percentage proportion does each hold in the hybrid model, i.e. the individual versus the company?
It's not determined on any fixed basis. It's a variable amount because that's what the partnership agreement says. So you don't have a fixed profit share per year. So you don't say 50% to me, 50% to the company. It's a variable rate that can change year on year. And that, sorry, Paul, and that variable profit share agreement isn't just a hybrid thing. So don't get fussed about that. It happens in accountancy practices. It happens in legal practices. It happens in surveyor practices, where a new partner comes in, for example. He might be a brand new partner. He might only get 5% of the profit share or a variable profit share, depending on the level of his fees he brings in. If he brings more fees in, he gets more profit. It's a variable profit share. It's a standard thing across lots of partnerships.
And I know from my experience, you can add a dormant company that's got losses in.
Absolutely. Yes, you can. Yes, you can. So this slide shows you 3 people, and it gets quite scary towards the right-hand side. So we're not quite at Halloween yet. We'll start on the left-hand side, and we'll get scarier as we go across to the right. So the first one is a typical person. They maybe have a couple of properties. They also have a little job, so they have 20%, 20,000 pay as you earn income. And under the old rules, you can see they'd have £80,000 of rental income, 20,000 of expenses, mortgage interest of 40. So they have a rental profit of 20, and they have a pay as you earn salary of 20. So under the old rules, their profit would be 40,000. Under the new, and they'd be a lower rate taxpayer. Under the new rules, the mortgage interest is disallowed, so their profit is 80 less 20, which is 60, add 20 salary is 80. So they are now a higher rate taxpayer. Scary. It's moved them from being a lower rate to a higher rate. And if they keep in that position, their tax will be £11,500 a year. The tax in the hybrid structure will be £4,900. A weekly saving of just over £100, £18 a day. Now, if we go to the far right-hand column, we have, I'll just move you here, Paul, because you're right over my words and I can't see what they are. So I just move the little picture. Oh, there you are. Yeah, you've been dragged across. Good lad. So basic rate taxpayer becomes advanced rate. So what does this mean? Well, look at the numbers here. He's got rental income of 250,000, expenses of 50, mortgage interest of 150,000. So under the old system, he'd have profit of 50,000. So he'd be a lower rate taxpayer. Under the new Section 24 rules, you add the 150 back. What does that mean? His profit's £200,000. He's gone from being a lower rate 20% taxpayer right to the highest rate of tax in the UK. He's lost his personal allowances. He's now at 45% tax and he's getting stung. Now, that his tax, his personal name is 45,000. Under the hybrid, it's 6,000. £38,000 saving, £700 a week. And that is not the important thing. That is not the nightmare, okay? The nightmare is the next piece I'm going to say. So listen very carefully. Look at his numbers. £250,000 of rent, 50,000 of allowable expenses, 150 of mortgage interest. He still has to pay his mortgage interest. His profit is 50,000. His tax bill is 45,000. He has got no money. Because what's Malcolm said at the very start, you have to pay a payment on account, which is half of the tax for the next year. So half of 45, 22 and a half. Where's he going to get the 22,500 from? Because he hasn't got it, because he's only made £50,000 in actual cash terms. This guy's going bankrupt. These examples that we have on the screen are real life examples. They are not made up. They are real life examples. For example, as an example, the left-hand person was my wife. The end person on the right-hand side was a guy that owned 4 or 5 properties. 14 or 15 properties in Canary Wharf. These are real people, and he was going bankrupt before he came to see us. His idea was to sell his properties. What happens then? He's got a capital gains tax issue. So where's he going to get the capital gains tax from to pay the tax man once he's sold them? He can't afford to pay the capital gains either. So these are real life scenarios here, and the savings are real life savings. So who's it work for? I shall just move you again, Paul, because you're right over my numbers again, or my things again. There you go. Thank you. Actually, it was the other way this time, but never mind. So if you're a new business or you're looking to get into property, then yes, this is a good system for you to use. If you're a full-time landlord looking to plan for your retirement, good system to use. Why is that? Because we're bringing the children in, so you've got another generation in behind you. You want to grow. Clearly, where you're going to get the investment from. If you've got more cash because you're paying less tax and because you set up as a proper business structure, then yes, you need to have a proper structure. I just said before, family businesses looking to keep the succession going. We've got lots of clients where they're teenage or early 20s children work in the business. The parents have been working in it for 30 years. The children are now looking to come into it, and we bring them in for succession. Who is it not for? Almost as an important question. If you're looking to pay less tax, and we have had lots of clients coming to us looking to pay less tax because of our name, clearly, then if that's purely what you're looking for, we will not take you on as a client. And the reason for that is that HMRC have got specific provisions in place that stop you just paying less tax. So if you want to drop all your properties into an LLP, a hybrid structure, and then sell them all to gain some tax advantage and then retire, then that won't work. HMRC have stopped that already. and we would concur that that is the wrong thing to do, and that does not work, and we would not help you do that. This is a piece of an exact extract from the legislation. It says tax motivated allocation of business profits will not be tolerated by the revenue. Tax motivated allocation. If you are allocating your profits under a partnership agreement or under a proper agreement, proper business structure, that is not tax motivation. Tax motivation is where you're doing it purely and solely to save tax. Really, really important point. I've just said this, if you're looking to sell your business in the short or medium term, then yes, we can help you with that. But again, you've got to be careful. Is there a business reason for doing this? Are you, for example, selling your worst performing units to buy better performing units? That is a business reason. That is not a tax reason. The HMRC could not go against that reason. If you don't have sufficient levels of business activity, then this is not you. So if you've only got 1 or 2 houses, or if you're not a serious going concern, then the hybrid structure isn't for you. It won't work because you're not running your business as a business. You're not running your property business as a property business, as a formal property business. So we all know about the Ramsey case. Mrs. Ramsey was the old lady who took the HMRC to court, and she won. She applied for CGT deferment under section 162. Incorporation relief. We all know that. CGT deferment has always been possible within mixed partnerships since 2000. So the same rules apply for mixed partnerships as they do for limited companies. Pretty straightforward stuff. So we can reduce capital gains tax after you've dropped your properties into the LLP. Now, again, I cannot stress enough, you cannot do that and then the next day sell all your properties and take the money out. That is not a business transaction. That is not a business reason for doing things. You need to have a proper business reason. That's why we write a business plan for you. We make sure that you stick to that plan. We update the plan every 6 months, and we ensure that the plan details every piece of your business. As I said before, it may be that you want to sell your properties in London, for example, that are only making you 3%, and then go and look in the Northeast where my properties are, that I'm making 12%. Business reason, nothing to do with tax. Business reason, that's fine. So, the summary of the hybrid structure. Securing low rates of interest. Why is that? Because the loans are in your own name. Succession planning. Why is that? Because we bring children in. In some cases, we bring children as members of the LLP. In other cases, we bring them in as shareholders in the limited company. Limited liability in ×2. What does that mean? That means that a member of an LLP cannot be asked to put money into an LLP if it goes into insolvency. And you've also got limited liability in the company. So you've got 2 hits of limited liability. There are no remortgage fees in this scenario because we are not selling the assets to the LLP. We are moving the equity. That's what we're doing. Now, look at those top 4 on that slide. Those top 4 have got nothing at all to do with tax. They are commercial reasons for doing this. This structure allows you to run your business as a trading business. You can therefore mitigate the mortgage interest, remain competitive in the marketplace. Inheritance tax can be reduced, so it protects the future of your business for future generations. And not only the first generation, but the second, the third, and the fourth. And the capital gains tax can be reduced as long as it's a legitimate going concern. And we've said that previously. Maximum tax rate, 20%. Why is that? Because we have the profit sharing agreement in the partnership agreement that can switch the profits from the company and from the individual into the company. So, hybrid benefits. Very quick slide. Left-hand column has what happens if you retain it in your personal names. Middle column, what happens if you transfer to a company. Far right-hand column, what happens if you transfer to a mixed partnership. So, do you get full relief for finance costs if you maintain the properties in your own name? If you're a high rate taxpayer, no. Limited company, yes you do. Partnership, LLP hybrid, yes you do. CTG mitigated on entry, not in your own name because you don't move them. Other two, yes. Any change of ownership? No, there is not any change of ownership in the personal, and there's none in the hybrid. There is in the company. Therefore, there's no remortgaging in the personal or in the hybrid. Is inheritance tax mitigated? Yes, it is in the hybrid in certain circumstances. Who is it mitigated for? In the limited company, probably only the next generation, depending on how it's set up. In the hybrid, all future generations, as long as they're brought into the structure correctly. Maximum tax rate, 45% in your own names or 60%. For those of you that don't know, if you earn between 100,000 and 125,000, tax rate in the UK is 60% in that 25,000 piece. Company, excuse me, company tax rate, 50%. That means if you take corporation tax, 19%, and then you take out a dividend on that and you take all the profit out, that dividend could be 38% tax. And then the hybrid business model is only 20% tax maximum, because you've got a corporate structure at 19 and 20% in the mixed partnership. And I think that's the piece when I hand back to Malcolm, I believe.
Well, not just yet, Chris, because you have generated dozens of questions.
A storm of questions.
Indeed. So I wonder if we could just go through a few of these, starting with, you mentioned generation upon generation. So do the kids have to be 18 plus to make them a shareholder?
No, they don't. If they're young children under 18, the shares can be held on behalf of them by their parents.
Lovely, thank you. I had one email to me earlier on, and I wonder whether you've covered it already, but I'll just double check. So a member's emailed in and said they believe that Less Tax for Landlords advocate a hybrid LLP model, which it sounds like you do.
Yep.
The problem is that income allocated to the limited co-partner can be reallocated by HMRC to the individual partners, is what they're saying. So
absolutely, and that's called a notional redistribution, and that's done by HMRC, but only done if that distribution or if that profit share is done on tax motivated reasons. If business reasons, then it is not. Now I'll give you an example. There was a court case called the Waliski case in February this year. It's a guy who used to work in the City of London. I believe he was a broker. He set up his own hybrid structure. He had profits in 1 year, and these are the correct figures, of £120 million. He was the only one working in his company and working in his LLP. So if he had not had a hybrid structure, that 120 would have been taxed on him. The company in the structure was owned by an offshore company in the Cayman Islands that was owned by his children. His allocation of profit was £1 million to him, and yes, you've guessed it, £119 million to the company. And HMRC thought that didn't work. They went to court, and the court agreed that because he didn't have the correct paperwork in place, i.e. no agreements between the company and the LLP, no agreements for him, so no contract for him, no contract for services. He was the only one in it, and it was clearly done because it was owned by an offshore company for tax purposes, that they said, we're not having this, we're going to redistribute it, and you're going to be taxing it personally. And that's what happened. And I would agree with them. There's nothing at all business related about that. Nothing at all.
Okay. Quickly from another guy, does this, for the hybrid system, how did the lenders view the setup, Chris?
We've spoken to more than 35 of the top lenders in the UK, and they're all fine with it. Absolutely fine with it. There are one or two where it needs to be explained to them exactly what's happening, but that isn't the lenders. That's that particular underwriter. And we've got a specialist team that deals with all this, and we talk to the underwriters all the time.
I think I'm fairly right in saying you don't have to have a LLP bank account.
No.
Nowadays.
No, you don't. No, you don't.
Balaji is asking, does the rental income have to be UK based, or can it be international rental as well?
Very good question. It can be international rental in certain circumstances. But again, you've got to ask yourself, why are you doing it? Is there a business reason? And I don't know the specifics clearly, but a lot of people own foreign properties in foreign companies. So you wouldn't have that in. If it's a holiday home, for example, in Portugal, maybe that might flow, you might want to put in. Well, why are you putting it in if it's a holiday home? If it's a foreign holiday let, then yes, you might want to put it in for business reasons. But you've got to ask yourself, what's the business reason for doing it? And that's what we would ask straight away.
Okay. Someone's asked, could the properties and mortgages all be held in individual names? I think you've answered this.
Yes.
But and the limited company be a trading company with allocation of profits of the LLP going or to the limited company?
Yes, it can be.
Yeah. Someone's asked a specific question. I don't know whether you'll be able to answer it. They're saying they've lent their company £250,000 through remortgaging their own personal house, which is on an interest-only mortgage. Can I charge the company interest?
Yes, you can, because that is a loan that you've taken out personally to fund a private limited company in the UK. So you're allowed to offset that loan interest on your tax return.
If you're looking to retire from the business in 5 years, would this hybrid structure be suitable or acceptable by HMRC?
It would be, because in your business plan, you would have a big line that says, I'm looking to retire in 5 years. I'm looking to retire in 4 years. I'm looking to retire in 3 years. And as your business plans grow, then that will be in them all. And we will do preparatory work. So you'll be looking to maximize the income in the period prior to retiring. And if you're going to sell them all, you might sell them over 2 tax years or over 3 tax years. You might not sell them all at once. You might keep some. So yes.
Someone's asking, in effect, is my equity going into my LLP? Does that affect or break my mortgage terms?
As we said before, no, it doesn't, but you need to talk to specific mortgage companies. Now, most of the mortgage companies don't have anything about that in their mortgage deeds. One company that does, and we're very honest with people, is Paragon. Now, we've spoken to Paragon underwriters. Different underwriters have different views on it. And we're talking to these people all the time. So we don't perceive that to be a problem. And again, it's up to the individual underwriter, but we talk to them, we deal with them.
Okay, I might need to speak to you about Paragon then.
Yep.
Fitzroy's asking, what's the cost of running all this?
I'll come on to that later, Paul.
Okay, I was going to say, I think the question you need to ask Fitzroy is, what's the cost if you don't do it? And as Chris has illustrated, it can cost you, it's not just this year, it's your future years' profits. Are you saying, yeah, we've answered that. Someone's asking, does your company use free agent? Don't know what that means.
Free agent, I think, is a pay-as-you-earn scheme. Sorry, it's a pay-as-you-earn software. I think.
All right.
I think. We use lots of different softwares.
Can you check what the detail behind the question is, Paul? And then we can.
He's just saying it is a software for accounting. He hasn't explained why he's asking about it.
Yeah, that's fine. So all that would happen is you would download a trial balance into Excel or whatever it is, and we'd upload it into our systems. It's pretty standard stuff. We use things like our QuickBooks, Xero. We've got a program called Cashflow. A lot of our clients just use Excel. You don't have to be. It doesn't have to be complex.
Right. Someone's asking what's the HMRC's view on hybrid, but you've already answered that by saying if it's for business purposes, there's no problem. If it's just for tax avoidance, then don't do it.
Yep, absolutely.
Okay, thank you. Brilliant. Thanks, Chris. Obviously, Chris will still be around for the next 10, 15 minutes, so back to Malcolm.
Let me stop sharing my screen first then. There we go. Hey, I'm not a technological idiot after all, everyone.
Right. Okay. I am though, because I'm in the wrong place. But never mind. We'll soon work our way through that. Okay. So I'm going to pick up from here. All right. So hang on. Yeah, I am a technological idiot, Chris. After all, let's go into there. Where are we? That is. Right, so hopefully, are you still seeing Chris's presentation, team?
Yes, we are.
No, I don't understand that. So I'll just quickly whip through it. I had started at the right place, but obviously didn't want to play. Okay, fine. So, what is right for you? So, as I said at the outset, we can only give generic information today. We very much encourage you to consider your own position, and if you think it's appropriate to talk to us, then we'd be delighted to talk to you. So, quickly, the high level. I just want to tell you about the hybrid. So, we've already touched on bank accounts. There's a question I think Paul raised. But our aim is to try to minimize the impact on your business operation if you do set it up. So there'll be no change to the legal title at land registry. So it's properties stay in your own name. There's no need to change. So you don't need to change your mortgage. And as we said, lenders are reasonably comfortable. But I always have to add a rider on this, and that is that obviously the PRA introduced some very different guidelines in 2018. And lenders are looking at things in a different way now to what they were 2 years ago, 3 years ago, even 6 months ago, pre-COVID. So lenders are looking at things from a very, very different end of the telescope, if you like, now than they were before. So, just the LLP itself is not going to be an inhibitor for getting mortgage finance. There may be other reasons that are. But again, we can cover that in the individual case-by-case basis. So as a generic point, not an issue, but undoubtedly the mortgage lenders criteria have definitely tightened, absolutely tightened. We have got, I'll mention how you get access to this later, but we have got what we call a video vault. In our video vault, we have a lot of information that tells you about the hybrid, tells you about what your options are, covers everything we've covered today, but in a little bit more detail. You'll all have access to that. I think Paul or Anthony will be sending a blog out later with the correct link. And on there, we will have information about mortgages. We'll have information about all aspects of this. So, we do recommend that you take some time to look at that if you are interested. Is the hybrid always the right solution? Well, clearly, absolutely not. It is all down to your individual circumstances. So, and again, we're very happy to take questions on this, but when would it be right for you? When would it be right for you? It is a flexible model, but if it's right for you, we need to know, and you need to know quite a few things. So I'm going to whip through a few slides just to sort of change sort of the mindset for a lot of people. We know this doesn't come naturally to everybody, but I'm going to start talking about things like mortality and death, what happens next. So the more we look into the future, the easier it is to get a proper solution in place for you. So if we're looking a year in advance, then fine. If we're looking 5 years in advance, fine. But if you're looking to the retirement, to your ultimate demise, what's going to happen? Are you going to have a business left behind or not? Are you planning on getting rid of all your properties before you go? These are really important considerations. Now, I mentioned earlier that you might want to go for the hybrid, or you might want to avoid a limited company if you're looking to pass it on. That's because of inheritance tax. So, but if you do want to sell, that's absolutely fine. But if you're selling a profit-generating asset, then you're going to need some other financial reserves to get you through from that point on to the end of your life. How do you calculate that? Are you going to get that judgment right? You're going to live off your capital, but how far is that capital going to go? You may end up, unless you know your date of death, you may end up with too much capital at the end or not enough capital at the end. And that's not really good. So that's why we, generally speaking, encourage landlords to continue to keep their business going until to the end of their natural. Now, obviously, again, some points there, but what's going to happen? How far are you thinking through? You're going to retire at some point. Now, I do this presentation many a time, and I have one-to-ones with people many a time, and I say, when are you going to retire? And the typical landlord says, I'm never going to retire because I love this too much. So I say, well, okay, so you're 97. Are you still going to be up a step ladder painting? Are you still going to have your head down the toilet fixing the latest block or whatever it might be? The point is, we're all going to slow down at some point. When you slow down, how is your business going to survive? For many of our clients, they're going to pass the business on to their children. So they can pass it on, and we can protect the legal ownership and all that, the tax situation. But how are they going to run it? Have they got the skills to run it? If one of you in the partnership, without being gender specific, one partner may say they run the business and their spouse doesn't really know anything about it, doesn't want to be involved. So if the partner who runs the business is the first one to go, what happens to that business when that first person goes? The point is, whatever you're doing, if you're planning for the future, you can start to mitigate against all these issues. But if you're going to do that, one thing is going to be common to this, and that is, if somebody else other than you is going to be doing some of the work or more of the work, then you're probably going to need to pay someone to do that work. If you're going to pay someone to do that work, that changes the maths, doesn't it? It changes the dynamic. It changes the profitability of the business. So we always encourage our clients to look at the combination of, you know, the capital appreciation they're going to get, but the rental yields they're going to get. What is that rental yield? Is it going to generate enough? Bearing in mind, you've got some additional fees that you're likely to incur, because you can't do this forever yourself. So that tends to encourage people. So again, I'm not sure where you all are, but I know a lot of people where they're in an area where there's been some significant capital growth. Let's just call London and the Southeast for an example. Because the capital values have gone up so much, the actual rental yields based on the current market value of the properties is typically around about 4 or 5%. And as Chris said earlier, where he is, they're 12%, 15%, won't get out of bed for less than 10%. It's a different world. So if you can generate more bang for your buck, then it opens up the opportunity to do that. A lot of people say to us, they don't want to own or run properties further than, I don't know, an hour from their home because they can't keep an eye on it. But if you think through to the future, when you're going to semi-retire or even retire, somebody else is going to be running that for you. So does that logic still apply? If that logic doesn't apply, then in theory, you could dispose of your 4 or 5% yielding properties and reinvest in a 10, 12% yielding property. That's one aspect. So these are things to look at. So we encourage all of our clients, we'll encourage all of you, whether you're interested in working with us or not, to just look at that portfolio. Is your portfolio giving you what you want now and at all stages in your future? It's all about the planning. I've touched on the video vault. Chris and my fellow director, Nigel Hawley's done a pretty good piece on business planning. That's in the video vault. So it's just an example. There's a half-hour overview of the business planning piece on there. So that'll be worth having a look at. Yeah, as this business has expanded, we continue to grow the services we offer. And a lot of that is built on what our clients are asking us to do. So we've got what we might call a phase 2 activity or phase 2 project going on at the moment. When you die, what's going to happen? Well, if you've got mortgages, those mortgages ain't going with you, are they? So your business has got to somehow work out how it's going to get rid of that mortgage. We will do a lot of that thinking with our clients to help them every step of the way. Somebody asked us earlier what the costs for this are, and I will answer that question, but in essence, it's driven by the kind of service that you want. So some people want to have an ability to have a protective structure in place, and they're driving all of the decisions themselves. Others of our clients want to have a more hands-on support. They might want to understand more about the conveyancing angle. We have a conveyancing business as part of our overall business. People don't have to use it, but they can. And if they use it, they could just use it as a transactional piece, or they could use it to get some real value add into what the ins and the outs are of any particular property they might be looking to buy. Some people want to buy in cash, but they want to mortgage in 6 months' time. You might get through the conveyancing process, but then you can't remortgage because there's something preventing it from being remortgageable. All that can be looked at and sorted at the outset, and that's what we do for our clients. So, next steps. Any of you who are interested, you can go on to that link at the bottom there, lt4l.co.uk/LNPG webinar. It's a link that's set up for you. It just means if you go into that, then we will know it's come from this webinar and we'll treat it appropriately. But the process is quite straightforward. You come in, you enter some information for us in terms of filling out an assessment. We will look at that assessment. We'll have a quick analysis of it. Someone will give you a call and help you to take the right next step. If you are a portfolio landlord and the LLP structure may be appropriate for you, then we'll ask for more information, like your tax returns, full detail of your portfolio, and we'll give you a complimentary consultation. Once you and we are both comfortable that it is the LLP structure is likely to be right for you, we'll invite you to the first paid meeting. That's a meeting with myself, Chris, fellow director Nigel, the heads of financial planning, the heads of estate planning that are looking after wills, powers of attorney, etc., on a 90-minute dedicated to you session. There is a fixed price for that. It's £3,000. There's no obligation to proceed beyond that. But the guarantee I will give you is that before we invite you to pay that £3,000, we will tell you for the service that you want, which would have explained how much it's going to cost beyond that £3,000 if you want to proceed. So we'll take you through the options, so you'll have all of that information before you come to that £3,000 meeting. 95% of people become a client after that £3,000 meeting. So that's our aim, and that's what turns out to be the case. So before we have the initial consultation, we will have done quite a bit of analysis on your case. You'll have a dedicated consultant talking to you. So this is, it's an important aspect to go through. We want to check your particular situation. We want to be able to answer all of your questions. You're going to say, do I qualify as a business, for example? How can we answer that question if we haven't had a conversation with you? So we'll go through it all. We'll explain it all to you. And if that's the right solution, then we can move on to the step 3 there, as I mentioned, which carries a fee for £3,000. If in that initial discussion, after you put your assessment through, the LLP isn't the right solution for you, we'll let you know. It could be as simple as a Form 17 might be the right solution for you. A limited company might be the right solution for you. We do not offer a one-size-fits-all solution. We will look at your circumstances and provide the best advice for you. So that's it. Prior to that, if you don't want to go to that step yet and you want to look at more information, as I say, our video vault is available for you. Again, you've got your own unique URL there, lt4l.co.uk/LNPG video vault. Again, you'll be given a clickable link to that in the blog that's being sent out. And in there, we've got, quite a lot of content. We're adding to it all the time. I say there's bits from me, there's bits from Chris, there's bits from Graham, who's the mortgage and financial planning person, Chelsea, who's the estate planning person, and a number of other members of our team. So it's not just the directors in there, it's the people who you'd be working with on a day-to-day basis as well. So that is it for me. So open to questions, guys.
I'm very glad you said that.
Do you want me to go, or are you going, Andy? Anthony?
I'll tell you what, I'll get these ones out the way that have come through from Facebook, and then we can...
Okay, great.
So slightly off topic, but do you advise on SSAS, pension and LTA lifetime allowance?
Yes. We do for our clients, and obviously we have a fully FCA regulated organisation within our group, so we can certainly handle those questions. Absolutely.
Lovely, thank you. And can you use another company that is in another trade for the hybrid model? It was a retail business, now it's property rental.
You can, yes. And if you want to get into detail on that, I'd have to bring Chris back in from the point of view of the tax situation. But in essence, the limited company member of the LLP can either be a brand new company, or it can be an existing company, either a trade or an investment company. We are, depending on the makeup of the overall portfolio, we can also get protection from inheritance tax for that company that owns investment properties, but it has to be a relatively minor part of the overall portfolio.
And one more, if I may, that is, if you have losses carried forward from previous years, can you decide to use only some of it and save the rest for future years when doing your SA returns?
Well, I'll let Chris answer that.
No, you can't. You've got to use them up in the so if you've got losses of 200,000 and you've got profit of 20, you've got to use the 20. You've got to use 20 of the 200. You can't say I don't want to use them. I'll use them next year. You've got to use them up on the way through.
Thank you.
Some questions on the Zoom chat. Is there a minimum number of properties for this hybrid scheme?
No. So we've had clients who've joined us that are just starting out and they want to set up their structure right in the first place. We do offer a slightly reduced service for them in terms of the price, but it's very much a question of, have they got the means, the motivation to actually set up something that's going to be worthwhile. And we tend to give a 2-year guideline to that. So if someone's going to get to the point where by growing their business within a couple of years, it's going to make commercial sense for them to be in the structure, then we're happy to work with those people. We just, part of the analysis we do is to make sure that, if someone's going to save significantly less than they're going to be paying us as a professional advisor, then clearly our advice to that person would be, don't do it. That is just daft. So that's why we look at every single situation, work out what they're trying to do. But where you're coming from is a significant part of it, but it's nowhere near as big as an important point, Paul, as where you're going to. So it's all about the motivation. It's all about the planning. That's the key thing to all of this.
Sure. Just in case I didn't make it clear at the start, I've been a client of Less Tax now for a couple of years. So that's duty of disclosure. And I think the comment I would say is that Nick did say to me originally, before we even spoken about allowing Less Tax to become a partner of LMPG, it's got to work. If it doesn't work for you, I'm not interested, was Nick's comment. So I would just say that it does work for me, and I will be allowing them as a partner to come on here if I didn't feel it was right for those members within LMPG who obviously want to grow their businesses. A couple of specific questions. Can you have more than one limited company as a partner in the LLP?
You can.
Excellent. Anthony touched on it earlier, but someone's asked, if we want to use a SaaS as an investment mechanism, is that okay to use with this hybrid? I'm assuming it'll be as a lender.
Yes, it is. It is. Yeah, it's fine. It's fine. Yeah. It depends. In your SaaS, you need a sponsoring company, so it depends where the sponsoring company sits in the structure. But yes, you can do.
The reason why I was being hesitating slightly there, Paul, is because there seems to be a view that SaaS is the answer to most things, and for a lot of people it isn't. So yes, technically, of course, we can. But we'd just like to get underneath what it is that the individual is trying to do, because that may not be necessarily the right way. Sure.
Okay, good point. Yeah. Someone's asking, do you have a barrister's opinion on the hybrid model?
No. What we have is HMRC's opinion on the hybrid model.
I mean, the other question that I saw earlier was, I'm concerned about the future costs. What guarantees do you have that a HMRC isn't going to outlaw it?
Okay, so there's a slightly complex answer, which I'll try to simplify. The structure is a standard structure, so there's nothing special about this. All we're doing is using existing structure for property, the same way that accountants and lawyers have been using the same kind of structure for their own professions for a number of years. So the opportunity for it to be moved back is very slim, very limited. Clearly, if there's not a business reason for doing it, then that would not be allowed, and we wouldn't allow that to go forward in the first place. In the highly unlikely event that there is an issue, then the legislation would normally change from a date at some point in the future. So the rules might change. It might be midnight tonight. It might be midnight on the 5th of April next year or the year after, in which case we would look at what the most appropriate solution would be at that point. In the even more unlikely event that there's some kind of retrospective view of this, which doesn't happen unless unless it's a scheme, which is a DOTAS, Declaration of Tax Avoidance scheme stuff. Doesn't happen. But if it did, then all of our, we are covered by professional indemnity insurance and also fee investigation insurance. So any inquiry from HMRC, Chris's team do all the work for that under that insurance policy. That covers up to Tier 1 tribunal. If we went to Tier 1 tribunal and HMRC were to win that, we would discuss things with our professional indemnity insurers and either proceed to Tier 2 and beyond, or in the worst case scenario, settle at that point. Everybody would be covered for up to £2 million per instance. On the accountancy side, it's £1.5 million. For the other parts of the business, it's £1 million, and we have an overall catch-all of £2 million per case. So we are as watertight and our clients are as protected as it is possible to be.
Someone's questioning whether it's a fully tested strategy. I think it's not necessarily tested because HMRC's never challenged it, has it?
We've had, just to confirm, we've put over 850 of these structures through HMRC over the past 4 years, and we've had 9 reviews of them by HMRC. Not one of those reviews resulted in more tax for the client. Not one of those reviews went past asking for all the information that we'd done to deal with the accounts. HMRC were completely happy with all the paperwork, with everything that we'd done. It was all sent to them, happy with it, and they were all closed down.
Excellent. Okay. Someone's asking, I think he's a bit confused with terminology. What do you mean by portfolio landlords? Because he's saying, can I use letting agents for fully managing the properties? Is this to do with partnerships, maybe?
No, it's just the criteria for mortgage is slightly different with portfolio landlord. So the definition of portfolio landlord is someone with 4 or more properties with mortgages. So it's just a terminology that we use. But in practice, as I said, if you've got no properties at all, it doesn't preclude you from being involved.
Super. I think that's it. I mean, I'm going to have to hold my hands up and apologise. I did say we'd finish on time, but as we've got still nearly 100 people on here, I hope you guys, it was okay going over the time that we'd expected. I think everyone's enjoyed that. Someone said I'm interested in the last question. I think the last question, the previous to last, I assume, was the question about, someone said that they spoke to Tony ages ago and they specifically said, what happens if you leave? And he was saying, my friend was quoted a massive amount of 12K as fees after the initial meeting. And he was saying, as it's not a fully tested strategy, I think as Chris has made out with over 850 hybrid companies put forward to HMRC, that would suggest it is a fully tested strategy to me.
I think if the question is about what happens if you come to work with us and you want to no longer work with us, then we don't hold people into contracts. So we do. I suppose you might describe it as a non-executive board kind of service for our clients. For some, that's quite detailed. For others, it's fairly superficial. But that's the concept. We're here. We combine the tax planning, the financial planning, the business planning, the conveyancing for people who want to use it. We don't hold people into contract. But once you've set up the structure, if there was an issue, we would obviously try to resolve what that issue was. But if you wanted to move away from less tax, then there's no problem with you doing that. But obviously, you would then lose the benefit of the professional indemnity cover that we have in place. If the question was someone wants to leave and they were charged 12k for leaving, then that's a misunderstanding, because that absolutely does not happen. The cost for leaving is nothing.
Yeah, I mean that massive fee, as they call it, is effectively setting up the structure so that you're at least legal and ring fence, if you like, to go forwards. But the danger is if you walk away, then you've still got that annual change, shall we say, as regards your profitability of whether you're switching it between the limited company and the partnership, isn't it? So
yes, someone's got to do that work. Someone's got to do that work, yeah. But I mean, as I said earlier, when we have the initial consultations with our clients or prospective clients, we go through all of this and we explain what it is. So what do you get when you set up with less tax for landlords? Well, first of all, you get confirmation that it's the right thing for you to do. And we'll go through the numbers with you so you can see exactly what the savings are in the short term and in the long term. We work out whether we want to work together. So that's a key thing. But then once we're set up, then not only do you get the structure set up, you get wills, you get powers of attorney for all of the personal members, you get the shareholder agreement set up, a partnership agreement set up, you get a business planning process with our business planning team, you get all the legal work that gets it all to hang together, like the transfer of the beneficial interest into the LLP. And it's impossible to demonstrate the value of that on a call like this, which is why we just say to people that we're not going to work with anybody if it's not in your best interest to do so. So if you're concerned about it, don't be. Pick up the phone, drop a line on that assessment link that we said, and we'll do our best to help you. And
you've also got IFAs and pension advisors and brokers, so it's a whole round gambit for professional advice.
We have, absolutely, it is there, and again, depending on what service levels the clients want, we can either be very proactive with that advice up front, or people can sort of work on it later. So for example, I touched on the phase 2 earlier, which is what happens when you die. Some people aren't interested in that. Shame, because they need to be. Some people probably don't have a death file. We would encourage everyone to have a death file. So if you were to die next week, next month, next year, where is someone going to go to find out how to run your business if you want your business to continue? So, again, it's horses for courses, but we explain all this on an individual level.
Yeah. I mean, if you've gone to the extent of setting up the hybrid structure, someone's saying, can it be undone easily in the future, or is it a major undertaking?
No, the beauty of the partnership is it's a standard stepping stone that a lot of people do if they're moving into standard incorporation. Because HMRC will often say to people, set up a partnership, run it for 2 or 3 years, then you can claim what is known as Section 162 incorporation relief to move into a limited company. So with the LLP, it leaves it open to move forward to the limited company, but also if the tax rules change, and it's more beneficial to effectively rip up all the legal documentation and return to where you are at the moment, then it's negligible cost. I mean, Chris will tell you the exact cost, but it's not much. It's a couple of forms, isn't it, Chris?
£10 for the LLP and £10 for the company.
Right.
That people shouldn't concentrate on the cost, because they'll weigh it up in their own mind, won't they? The cost against what they're saving in tax and their business structure. Yeah. What Paul's dead right. I'm not a tax expert, and I said, Paul, before anybody does a presentation, make sure it works. And Paul, you've been a client of theirs for 2 years now,
Yeah.
and that's why I'm more comfortable about. I know a kitchen, I know a boiler, I know that's on the wall, I know it works. Yeah, and Paul is an accountant, and he's done this for years, and that's why I haven't said a lot tonight. But I don't think people, if it's costing you £12,000 and the overall deal's costing you 15,000 for it, I don't even know what the fees are. Well, there must be a benefit for you to be charged at 15,000 or whatever the figure is. Because if it's not a benefit, that you wouldn't pay the 15,000. You wouldn't be a member of yours. So I think people need to concentrate on, is it right for them? And I've got my serious head on tonight because I found it fascinating. I really, really did. And you've got to think about long-term planning. When I was a broker, it was all about long-term planning, not immediate short-term. And I think people get so caught up in what's in front of them. They forget what's in front of them in 5 years, 10 years time. And when you get to my age, it's a blick of a finger. It's a blink. You blink and suddenly you're 10 years older. It's about planning for your future. And I was really impressed with what I saw tonight. And I really, really was. So concentrate on what's right for you. If they're not going to save you or the planning's not worth that kind of money, then don't get involved. That's all I would say. If it is, and it's going to make you a lot more efficient, I'll use that word, efficient, in running your business, 15,000.
Okay, ready to do chemistry or 10 minutes? Do you want a drink? Tea?
Oh,
Can someone, Cam, you're muted.
I've just muted it.
it's about the long-term future of your business. I don't care what it costs. If it improves your business and it makes you more efficient, then there's that kind of work to be done. So all I would like to say is thank you on behalf of LMPG and the 200 odd people that joined this webinar and all the people on Facebook. Really impressed, and thank you so much. I hope I don't eat my words.
Before we go, Nick, can you just let everyone know what we're doing next?
Yeah.
Back.
And before we're going, I just want to have a quick dig at Paul. Paul, what time is it?
Oh, I can't hear you, mate. Sorry. Mute him, man. Anthony, mute him.
An hour and a half. I have never gone past this time. Yes, ever.
Wow.
I think so.
I have never been this overrun. And anyway, it was really interesting.